Okay, let's unpack this. Welcome to the deep dive. Our mission today is, well, to really get into the details, the complex insights from the Q&A session after Lemonade's Q3 2025 earnings call. We want to synthesize all that dense financial talk into something, useful and understandable. We're looking at how they're scaling an AI-first insurance company.
Absolutely. And the source materials we've looked at, they paint a picture of a company that's not just growing, it's actually changing the basic economics of insurance. They put up some aggressive numbers like 30% growth in in-force premium, IFP, that's their total current policy revenue annualized. And they're doing this while at the same time making these really dramatic, fast improvements in profitability. And it seems like AI is, well, almost entirely the driver behind that.
Yeah, and that IFP growth, it's happening even as they're intentionally getting rid of some policies. That's a key point, a bit counterintuitive, that we really need to dig into. The questions from analysts and retail investors, too, they seem to zero in on like three main things defining where Lemonade is heading. First, this radical operational efficiency. Second, how they're scaling up their car insurance product. And third, this really fascinating, almost philosophical change in how they think about profitability metrics.
Right. And get ready for some pretty crucial structural insights here. We're going to talk about what negative CAC actually means for their unit economics. We'll look at why management is basically saying out loud that a higher loss ratio might actually be a good thing in some cases. And we'll get into the details of how their own platform, this no-code thing, is completely shifting what their engineers are working on. This is really a deep dive into treating old school business metrics less like fixed targets and more like, levers you can pull.
Okay, so this structural advantage, it really starts with AI driving efficiency. And the clearest number, the metric that really shows this one that finance people watch closely but maybe not everyone knows, is LAE. So what exactly is LAE and why is Lemonade's performance here so, well, startling?
So LAE stands for loss adjustment expense. Basically, it's the cost to manage and settle a claim. Think of it as a percentage of the premium. It covers all the overhead, the people, the systems, the process costs that happen on top of the actual money paid out for the claim itself. So yeah, a low LAE, that's a really definitive sign of super efficient operations.
And the context here is just so important. If you look at the big established insurance carriers, the ones they're up against, typically their LAE is somewhere around 9% of premiums. That's kind of the benchmark for having scale and maturity in the industry.
Right. But Lemonade, even though they're much smaller, way less total volume than those big guys, they've already hit an LAE of 7% across all their products. Better than the benchmark. But honestly, the real story isn't just the 7% number right now. It's the trend. It's the trajectory. The sources confirm they've cut their LAE ratio in half over the last 3 years.
That's just incredible progress.
Yeah.
But it gets even more head-turning when you stack up the volume against the number of people involved. So same 3 years, they cut LAE by 50%, but their claim volume, it grew 2.5 times. Get this, the number of actual human claim adjusters they employ went down. That's not just leverage, that's like structurally different from how the rest of the industry works.
It absolutely is. And the reason they give, it comes down to their AI operating system. They call it Blender. Management explained that Blender lets their human adjusters handle, on average, 3 times the claim volume they could manage before the AI help. And this isn't just simple automation like filling out forms. It's AI augmenting the human workflow. It handles the bulk of routine stuff, identifies the tricky ones, and gets those straight to the expert fast.
Let's break down that augmentation idea a bit more. Because normally, if your claim volume goes up, you need more people, more hiring, more training. That's a variable cost, right? It scales up. But if Blender does the first pass the intake, checking documents, all that, it lets the human adjuster jump straight to the part that actually needs their judgment.
Precisely. They skip the low-value steps. And crucially, this isn't just a one-off efficiency gain. They've set a super aggressive target going forward. They actually expect to cut the LAE ratio in half again while the business doubles in size next time. Getting single-digit LAE growth while doubling volume, that tells you they think these AI gains aren't plateauing. They think they're actually accelerating.
Wow. Okay, but hitting that kind of target, that relies completely on the tech getting better and better, right? Which brings us to this other thing. They talked about this radical new platform for actually building the insurance products themselves.
Yeah, that's their local platform. They described it as the next generation LLM first no-code insurance product builder. Quite a mouthful. But the idea is basically to get the engineering bottleneck out of the way when they want to create or tweak products.
So it fundamentally changes what engineers do. But hang on, relying that heavily on a no-code LLM platform,
Mm.
does that create new risks? Like,
Yeah.
what if the underlying AI model changes or regulations get way more complex? Are they betting against that?
Yeah. That is the critical question, isn't it? And yeah, they're clearly betting the upside outweighs that risk. Management's point is that the core function of local LUD, it lets the product managers and the actuaries, the insurance experts, configure, design, test, and launch entire products, compliant products, without writing code.
So the product people become their own developers in a way.
Essentially, yes. And they talked about a massive impact on speed. Things that used to take like complex engineering sprints, maybe weeks, launching a new coverage option in one state, for example. Now they're saying it can happen in hours. The strategic result is huge operating leverage. It means your engineers, your most expensive people, can focus purely on the big foundational stuff, scaling the core AI, integrating complex data feeds. They're not tied up configuring policy logic.
Okay, let's switch gears slightly to how widespread this AI use is and this kind of strange paradox when they were asked to rate themselves. And an analyst asked them, scale of 1 to 10, how far along are you with AI?
Yeah, this was, I thought, one of the most telling moments in the whole Q&A because they gave two answers at the same time. And they kind of contradicted each other. So on one hand, they rated themselves a 10, but that was specifically compared to their industry peers.
Right. And they backed that up. They pointed out AI touches pretty much every line on their P&L. It's not just a claims thing. They said something like 90% of their customer acquisition budget is guided by AI using over 50 different machine learning models to optimize spending based on predicted LTV to CAC.
And they even mentioned that most of their actual software code is now written by AI.
So that's the 10 out of 10, the external, how are we doing against the competition rating. But then their internal rating against their own potential. They said they were a 1. They basically said, we're just getting started. And the reason, the whole field is moving so fast, AI models get smarter, they get more capable, the goalposts are constantly shifting. They see this huge blue ocean of stuff they haven't even touched yet. So even though they're way ahead now, the gap between now and what they think is possible is still enormous. That paradox really sums it up, doesn't it? You're simultaneously way ahead of the pack, but barely scratching the surface of what the tech can do.
And it's this tech leadership that lets them do something really sophisticated financially, converting variable expenses into fixed costs. This is like the ultimate financial signature of a true AI-first company.
Explain that conversion, because yeah, it sounds elegant, but what does it mean in practice?
Okay, so think about a traditional business. More customers usually means more costs that scale up directly. More claims calls, more support chats, more policy questions, so you need more people. Costs go up in line with volume that's variable cost. Lemonade's strategy is to invest heavily upfront in building systems that break that linear relationship. They want a fixed cost structure.
And they give a specific example, right, about automating the improvement process itself.
Exactly. In the past, maybe an AI chatbot handled a customer interaction, but then a human still had to review some of those chats, figure out how to make the bot better, and then manually update the system. That review process, variable costs tied to volume. Now, they're saying their AI tools automate the review, the analysis, and the implementation of those improvements. The AI basically audits itself, finds flaws, fixes them, and rolls out the fix instantly across all interactions. Building that self-improving system costs a lot upfront. That's a fixed investment, but it gets rid of that ongoing variable labor cost forever.
So spend big once to build the machine, create a fixed cost base, and then that structure can handle massive growth in volume without operational costs exploding. That really explains how they can keep overall expense growth in single digits while the top line is growing over 30%. The leverage is just built into the architecture.
Okay, let's pivot now to how all this efficiency is fueling their growth engine, specifically with the car product. It seems like cross-selling is really changing how they get customers. Yeah, the numbers here are pretty stark. They said over half, 50% plus of their new car customers are coming from people who already had another Lemonade policy, like renters or homeowners. And importantly, this isn't just a recent spike. They said this cross-sell rate has been steady for several quarters now. It's clearly a core part of their growth plan, very reliable.
And the common way people talk about this is, oh, those are CAC customers, zero customer acquisition cost. But management actually pushed back on that term. They said it's not quite right. They described them more accurately as negative CAC customers. What's the difference there?
That distinction is really, really important. Okay, so CAC-less just means you didn't spend new marketing dollars to get that specific customer for that product. Fine. But negative CAC-less That means the customer was already profitable from their first policy. Say they have a renter's policy, they stick around, they don't cost much to service, they're already making Lemonade money. So when they add a car policy, Lemonade is just layering more gross profit onto an existing profitable relationship. The cost to acquire that car business is effectively less than zero because it's leveraging profit that's already there.
And it sounds like these aren't just any customers either. They're better customers overall.
That's what management emphasized. These cross-sold customers, they tend to have much better loss behavior, fewer claims, less costly claims, and they stick around longer, much higher retention rates.
Right.
So you get a great renter's customer, low risk, high retention. When they add car, they're not just adding premium, they're actually boosting the profitability of the whole relationship significantly.
It's like a virtuous cycle then. You leverage your existing good customers to grow into new lines, and that makes the whole thing more profitable and sticky.
Exactly. And that's why they mentioned the rate of customers holding multiple policies has gone up every single quarter sequentially. That mechanism is gaining steam, not slowing down.
All right, looking ahead a bit. Lemonade seems to be betting big on the future of driving specifically. This whole uncertain shift towards autonomous cars, full self-driving, FSD. Management admitted the timeline is fuzzy, nobody really knows, but they argued their whole system is built for that future whenever it arrives.
Yeah, they see FSD playing right into their hands, actually. While it might be a huge problem for the old guard, the legacy insurers. Because think about it, autonomy means insurance will need usage-based pricing, it'll need to handle tons of real-time data from the car, offer flexible coverage that changes dynamically. These are all things Lemonade built its tech for from day one. Data liquidity is core. Legacy systems, they just weren't designed for that kind of real-time, high-volume data flow.
And they didn't just talk theory, they announced something concrete.
Right.
Right, a direct integration with Tesla's API.
Yes, and that's a potentially huge differentiator. If the customer agrees, Lemonade can pull data directly from the Tesla vehicle systems. And that data is apparently much richer, much more precise than what you can get from just a phone app or one of those plug-in OBD dongles.
What makes it so much better? What kind of data are we talking about?
They mentioned things like knowing exactly when seatbelts are used, highly accurate trip details, start, stop, acceleration, braking patterns, stuff phone apps often guess at or struggle with. This richer data, it doesn't just make their pricing and underwriting sharper today, which is already a big advantage. Critically, they said it positions them to learn directly from the evolution of FSD systems over time. And they're basically collecting the ground truth data needed to figure out how to underwrite the car's AI system risk, not just the human driver risk.
But that FSD timeline is so up in the air. I mean, it could be 5 years, could be 15. Are they worried about investing heavily in a future that might take ages to get here?
They acknowledge the uncertainty, sure, but their argument seems to be that the tech needed for FSD readiness, the high-fidelity data handling, the real-time feedback loops, that's also the tech needed to offer the best usage-based insurance today. So it's kind of a win-win. They get an edge now with better pricing, and they're automatically positioned for the FSD shift later. This direct API access, especially with a leader like Tesla, could create a really steep learning curve for competitors trying to catch up with inferior data.
Okay, let's talk about the overall mix then. Car is still relatively small for them, right? About 15% of their total IFP. What's the long-term plan there?
Right, it's still early days for car in their overall book, but they pointed back to the goal they laid out at their investor day. The big vision, growing from around $1 billion in premium today towards $10 billion eventually. That plan assumes car becomes a much bigger piece, maybe around 40% of the total premium, just based on how huge the auto insurance market is.
Whoa, 15% to 40%. That's a massive shift. What about the next couple of years? What's realistic?
They suggested something in the low 20% range seems reasonable for the next couple of years, but they were really clear. Given the size of the market, there's no capital constraint holding them back on auto. They have the money, they have the reinsurance structure, which we should definitely get into, to go after profitable auto growth aggressively, especially using those super valuable cross-sell customers.
All right, this next section gets into what feels like a really core philosophical difference between Lemonade and traditional insurers. The idea that loss ratio, the percent of premium paid out in claims, isn't the ultimate goal. It's an input.
Yes, this is absolutely critical to understanding how they think about their business and their unit economics. Their main operational target, the thing they're trying to maximize, is absolute gross profit dollars, not the loss ratio percentage. They see that loss ratio percentage as just a lever, something they can adjust, even let it go up sometimes, if it helps them generate more total profit dollars overall.
Okay, but wait. Sacrificing margin for volume. That sounds like the classic Silicon Valley growth at all costs playbook, doesn't it? How do we know they're not just, giving away the farm? Are they watching anything to make sure they don't push that loss ratio lever too far?
That's a totally fair question, and yeah, you have to be skeptical. Management addressed this by saying the relationship between the loss ratio percentage and the actual gross profit dollars isn't straightforward. They called it non-monotonic, which basically means it's not like lowering the loss ratio always gives you more profit or raising it always gives you less. There's a curve, and they claim they're constantly measuring where they are on that curve.
And what does their data apparently show? Why would raising the loss ratio sometimes be better?
Their point is that insurance is very price sensitive. So if they strategically lower their price just a little bit, which, yes, makes the loss ratio percentage worse, trims the margin on each policy, that price drop can lead to a much bigger increase in the number of people buying policies, conversion, and sticking around retention.
Okay. So the volume increase more than makes up for the slightly thinner margin on each policy.
Exactly. They might sell way more policies at, say, a 75% loss ratio than they would at 70%, and end up with significantly more total gross profit in dollars, even though the percentage margin is lower. They were really blunt about it. If given the choice, we will always privilege dollars over percentages. Their argument is that their AI-driven efficiency gives them the room to do this. They can operate profitably at margins where a legacy carrier with higher costs would lose money.
And the numbers seem to back that up, right? Loss ratio has been coming down, but their actual gross profit dollars have rocketed up something like 261% over 2 years. That suggests the volume effect is winning.
It does. Which then leads to the obvious question about that 73% target loss ratio they used to talk about. Their current trailing 12-month gross loss ratio is down at 67%, the lowest it's ever been. So is 73% even relevant anymore if they're already way below it?
And the answer seems to be not really.
Yeah, pretty much. Management made it clear there isn't one single target loss ratio for the whole company anymore. That 73% number was useful guidance in the past, but now, with multiple products, different customer segments, they need a more granular approach.
And this connects right back to those negative CACs customers we talked about.
Exactly. They used a hypothetical for those cross-sold car customers, the ones who cost almost nothing to bring in because they're already happy renters. They could theoretically be super profitable even if the loss ratio on that specific car policy was 90%, as long as that price point maximized the total dollars generated by bringing in lots of those valuable customers.
So instead of one target number, they're constantly tweaking things. Different loss ratios for pet versus home versus car, different targets for different marketing campaigns, maybe even different states.
That's the picture they painted. Continuous fine-tuning. Product by product, campaign by campaign, region by region, letting different lines run at different efficiencies, but all aiming to maximize the total pot of gross profit dollars. It's very dynamic, driven by elasticity and LTV predictions.
But despite being flexible on these intermediate metrics, like gross margin percentage, they seem absolutely rigid on the ultimate bottom line goal.
Completely. They were very firm, no change to the plan to hit adjusted EBITDA profitability in Q4 of next year.
Right, that target's been out there for 3 years, and they're calling it locked in now. So the message seems to be, we know where we need to end up, EBITDA positive, and we're committed to that. But the path to get there might involve strategically flexing metrics like gross margin percentage, using them as tools to drive the necessary volume and dollar growth to hit that final non-negotiable target. Okay, let's shift focus geographically for a moment. Their European business seems to be doing exceptionally well, especially compared to how the U.S. business looked at a similar stage.
Yeah, the numbers they shared were pretty remarkable. Europe performing spectacularly well, about 170% growth in the quarter. The customer base doubled year over year. So clearly, the international expansion playbook is working over there.
But the really interesting part, for me, was the loss ratio comparison. They said Europe's loss ratio today is 30 points better than the U.S. business was when it was the same size. 30 points. That's a huge difference. What's driving that? Is the tech better? Are the customers different?
Surprisingly, they said the main driver isn't tech or customer profile. It's regulation, specifically regulatory freedom. In the U.S., as you know, it's this complex 50-state system. If they want to change prices or tweak a product, it often involves lengthy filings, waiting periods, sometimes months before they can actually implement a change.
Right, and that delay must be killer for a company built on real-time data and fast iteration.
Exactly. But in Europe, they generally have much more freedom to adjust prices dynamically. If their AI spots a pricing error or sees risk shifting in a certain segment, they can often make the correction almost instantly. There's very little lag time. That hyper-responsiveness means they can squash problems and optimize pricing way faster, leading to that much better loss ratio performance compared to the US at the same stage.
And they're also starting to see benefits from the mix of products in Europe, too.
Yes, exactly. They mentioned the UK market is growing strongly, especially the renters insurance book there. Renters naturally has a pretty low loss ratio, so that helps the overall European average. Plus, they now have a working home insurance product in 3 out of their 4 European territories. So that opens up more chances for that valuable cross-selling, that negative CAC dynamic we talked about.
Okay, shifting from geography to specific product line. Pet insurance. It's a big part of their business. How's that performing? What role does it play strategically?
Pet seems to be the steady workhorse. Loss ratios are super stable, very predictable. It's a reliable foundation for them. And its growth is getting a nice boost from that partnership with Chewy. They mentioned Chewy now drives almost 5% of their pet business, which shows those kinds of distribution partnerships can really move the needle.
Now, they put that performance in context, right? Comparing their speed to legacy players.
Yeah, they made a point of saying they achieved in like 4 or 5 years what some of the specialized pet-only insurance providers took maybe 10 or 12 years to build. So again, it highlights how their tech platform lets them scale up faster, even in these niche verticals compared to companies built on older systems.
And presumably, they apply that same maximize dollars, not percentages philosophy to pet as well.
Absolutely. They said they maintain a super competitive price point, but they stick to their guns. If a potential policy doesn't meet the profit requirements of their LTV models, they're okay letting that business go elsewhere. Pet is clearly a key, high-quality part of the business that helps them hit that overall 30% plus growth target, but they won't chase unprofitable growth there either.
Okay, let's dive into the pure financials now, starting with operating expenses. Q3 saw expenses tick up, both from Q2 and year over year, especially in tech and G&A. Given all the talk about efficiency, why the increase? What drove that?
Yeah, they addressed that directly. Management broke it down into a few key drivers. First, just straightforward growth spend was up 16% year over year, about $46 million in Q3. They basically decided to lean in and spend more on growth because their unit economics have improved so much. Makes sense. Second, tech personnel costs were higher. They're still investing heavily in hiring the AI and engineering talent they need to build out things like local and keep improving Blender.
Okay, and the third piece was G&A interest expense going up. That connects to how they're funding things, right?
Exactly. That interest expense is rising because they're actually financing about 80% of that growth spend we just mentioned. So while, yes, it shows up as a higher expense line item, it's actually a deliberate strategy to be more capital efficient. It gives them a big cash flow benefit by spreading out the cost of acquiring those customers over time rather than paying it all up front. But the key point, the one management really hammered home, was that even with these increases, the overall expense growth is still way down in the single digits, while the top line, IFP, is growing over 30%. So that confirms that variable to fixed cost conversion story we talked about earlier is still very much playing out. The leverage is real.
Okay, let's talk capital management and reinsurance. This stuff gets complex, but it's crucial for how they manage risk and smooth out results. Analysts asked why their ceding commission revenue went up specifically, why it was a higher percentage of the premium they ceded to reinsurers.
Right. And the answer ties directly back to how well they performed on claims in the quarter. It's all about the structure of their reinsurance deals, specifically their quota share agreements. Think of it like this. They share premium and risk with reinsurers. Part of the deal is that the reinsurers pay Lemonade a commission, and that commission rate isn't fixed. It's on a sliding scale.
Meaning, if Lemonade's results are better, they earn a higher commission rate.
Precisely. Because Q3 had that record low gross loss ratio, it basically unlocked a better commission rate from their reinsurance partners. You could see it as the reinsurers rewarding Lemonade for good underwriting and efficiency because it means less risk and less volatility for them too.
And the Q&A also confirmed a really significant structural change in their reinsurance that started back on July 1st.
Yes, this is a big strategic shift. They are keeping much more of the risk and therefore more of the potential profit themselves. They're increasing their retention significantly. They're moving from ceding or passing off about 55% of their total business to reinsurers down to a target of only ceding about 20% by sometime in mid-2026. That's a huge vote of confidence in their own underwriting ability. It means they expect to keep a much larger slice of the profit pie from the policies they write well.
And what's the immediate effect? Does it take time to get to that 20%?
It does take time because policies have to renew into the new structure. but they said the effective overall seeding rate in Q4 is already expected to drop to around 40%. So going from 55% down to 40% in just 6 months or so, that shows the strategy is kicking in fast and will start boosting their retained premium and profitability quite soon.
Okay, let's wrap up financials with guidance in this whole question of conservatism. Q3 was a beat. Annual dollar retention, ADR, ticked up nicely improved 1.85%, reversing that earlier dip. Yet management sounded pretty measured, maybe even cautious, on the IFP guidance going forward. Why the restraint if things are generally improving?
Yeah, they were definitely thoughtful, as they put it. The caution seems mostly tied to retention, and specifically retention in the homeowner's book. And it comes back to that clean the book exercise they've been talking about for a while now. They're still actively, intentionally pruning policies that don't meet their current standards. Maybe they're unprofitable, maybe the risk profile isn't right, maybe they just don't fit the LTV model anymore.
So that pruning is still ongoing. It's not finished yet, and that's suppressing the headline growth number a bit.
That was the message. They said the impact of that pruning in the second half of the year will likely be similar to the first half. They are choosing to shed some policies to improve the overall quality of the book long term. And the really crucial context is that the 30% growth rate they are delivering, that's happening despite this active pruning. They're prioritizing long-term health and profitability over just maximizing the IFP number in the very short term.
That definitely sounds disciplined.
Yeah.
And reinforces their commitment to hitting that Q4 2026 EBITDA target. They seem willing to accept slightly slower top-line growth now to make sure the foundation is solid.
One last quick point from the Q&A, the new board members. They added the CMO from PayPal Venmo and the VP of AI products from Meta. And the reason given wasn't about potential corporate partnerships or deals. It was purely about bringing in specific strategic expertise.
That seems very targeted. AI and brand, arguably the two most critical things for Lemonade's strategy going forward.
Exactly. Prashant from Meta AI brings that deep, practical knowledge of deploying AI at massive scale, essential for things like Local and Blender. And Jeff, the CMO, has experience building huge consumer tech brands, PayPal, Venmo, even Airbnb before that. It really looks like a focused move to get the right strategic guidance at the board level for their core tech and brand building efforts. Hashtag outro.
Wow, okay, that was definitely a deep dive. So just to quickly pull it all together, the big themes we've hit, it really starts that structural advantage from AI, turning variable costs into fixed costs. That creates massive operational leverage that legacy players just can't easily replicate.
Right, and we really unpacked the economics of the cross-sold customer, understanding why negative tax is so much more powerful than just CACless. And then there's that fundamental mind shift, viewing the loss ratio not as a fixed target, but as this flexible tool you use strategically to maximize the total dollars of profit, not just the percentage margin.
So what does this all mean for you listening? Well, Lemonade seems to be proving that if you build the right tech foundation, you can open up pathways to growth and profit that are just different. They're inaccessible to traditional insurers, stuck with legacy systems and cost structures. It lets them be price leaders, potentially absorbing thinner margins because they know their efficient fixed cost base can handle the volume profitably where others might struggle.
And that last point we touched on about FSD and the kind of super granular data they're getting from that Tesla API integration, seatbelt use, precise trip data, it really sparks a fascinating question about where insurance might be headed long term. If or when autonomous systems dramatically cut down on human-caused accidents, what does insurance even become? Does the focus shift completely away from evaluating human risk?
And if it does, maybe it becomes more like product liability.
Yeah.
Right? Holding the AI systems, the manufacturers, accountable when things go wrong. And if that happens, well, the kind of incredibly detailed real-time data Lemonade is collecting now, it stops being just useful for pricing today's risk. It could become the absolutely essential, priceless forensic evidence you need to figure out who's liable in that future autonomous world. It fundamentally could change what data matters most and who holds the keys.
Definitely something to think about until our next deep dive.
Absolutely. We'll talk to you next time.